Hello, wonderful people. Welcome back. This is video 3 of chapter 12. We're going over the types of poverty reducing programs. So the United States employs 3. We have welfare, we have guaranteed income level, and we have market-oriented programs. Now, welfare is long-term. Welfare is usually somebody stays on welfare something like 2 to 3 years. It's not true that they can be on welfare indefinitely. There's usually 3 times a lifetime possibility, with at least 1 year in between where somebody is not on welfare. So those days of, I hear people say things like, oh, somebody can just stay on welfare indefinitely and just has more and more kids. None of that is true. Now, usually people on welfare are unemployed or they work very limited hours because welfare penalizes people who do work. And this is the biggest disadvantage of welfare, is if you actually wanted the assistance, but you found the opportunity to earn more income, they take away the assistance, right? So we don't like it predominantly for that reason. It's a disincentive to work. Guaranteed income level is something that most economists stand by more than welfare, significantly more. Guaranteed income level is you're given money. It's all about cash. We give you money, you figure out how to spend it. Now, in the United States, we really have a hard time giving people money and not monitoring how they spend it. But program after program has been instituted around the world, and so far they've been successful, where you don't give people conditions. You say every month you're going to get $800, for instance, right? What you do with it is up to you. And what we find is most people employ it quite well, and a lot of people actually start to become self-employed with it. So the earned income credit is the closest thing to it in the United States, where a family has enough income. I mean, they work, they have income, but it's not enough to meet the amount of income they should have to live on. I'll give you an example of that, before we're done. So the government ends up guaranteeing, it's basically a negative income tax. Let's look at it that way. It's a negative income tax where you get back more than the amount of taxes you actually paid in. Such people tend to be employed and they tend to have dependents. Market-oriented programs are like unemployment compensation. They are short-term. What we want is for somebody to, as quickly as possible, go get a job. So they could be on it for only a couple of weeks. And if you find work, then you don't actually qualify anymore. And the only way you qualify is because you're unemployed. So to recap a little bit, welfare, typically people are unemployed or they work a limited amount of hours and they can be on it long term. Guaranteed income level, people are working, and this is like an incentive. It's like a reward for you work, but you don't make enough money, so we'd like to catch up your income. It's not going to be enough, but it helps. Market-oriented programs is more like we want you to get a job ASAP because you don't have one, and it is as short-lived as possible. Those are the 3 programs. Now, to look at them in a little bit more detail. So here are the major reforms of social welfare, right? So when we talk about welfare, we're looking at people getting things like food stamps, disabilities, social like disability income, tax credits, so they actually end up paying less, housing assistance, subsidized housing, vouchers, which really work in the same way, definitely food assistance, right, and healthcare, which is Medicaid, just healthcare for people whose income is lower. And so this is what people basically need: a place to live, food on the table, keeping more of their income that they do have in their pockets, getting assistance with food and housing and healthcare. This is what we basically look for. Now, there are a lot of inequities, and there are some like 77 overlapping welfare programs, which is kind of crazy, but that gives you an idea. Now, guaranteed income level is really much more about cash. If you look at it, cash assistance helping families to stabilize the family, cash assistance to promote racial equality, cases, notice cash. So it's given to people whose income is just not necessarily satisfactory, and it's an example would be temporary assistance of needy families. And such a program can extend to the long term if those, if such a family continues to need assistance over more than 1 year, for instance, or 2. Now, market-oriented programs, they are like unemployment compensation, unemployment benefits. They tend to last about 52 weeks. An example would be, like I write here, unemployment compensation. Remember, the idea is to return people to work as soon as possible. Now, I'm going to come back to the guaranteed income level in a minute. Cash transfers versus in-kind. Welfare focuses more on in-kind. Even though some people can get a welfare check, it's really mostly an in-kind transfer. In-kind transfer, you're not giving people money. You're giving them, for instance, free healthcare. That's not giving them money. You're giving them the food. That's not giving them the money. So the money that they are receiving is really in the form of an item, an assistant, a thing. They are not getting a check necessarily in their hands. Now, if it is a cash transfer, it is cash. You get a check, and like Social Security is considered a cash transfer. Now, granted, you paid money and this is why you're getting it back, but it's coming to you in the form of a check. If you want to spend it on a vacation because you have other income, you can, right? But if you're getting food stamps, you can only spend it on food. So food stamps, rent, subsidies, Medicaid, in kind. Anything in the form of cash like Social Security payments, unemployment benefits, workers' compensation. Those are actually cash transfers. And often we find that cash transfers are more effective than in kind. They don't need as much monitoring. They don't have as many restrictions. They don't penalize people unfairly. Now, there's a lot of criticism of welfare, and then this is why I'm going to go to the guaranteed income level in contrast, which is the negative income taxes. Welfare criticism. Why is welfare, not ideal? Well, let's see. Welfare is seen as being a work disincentive, meaning, remember I was telling you before, if you qualify for welfare and then you want to work, let's say 25 hours, but the maximum you're allowed to work is 14 hours, well, that's ridiculous because now it's preventing you from actually earning that extra income. Inefficiencies, bureaucracy, and politics. Those applications are ridiculous. You fill them out wrong, you don't qualify. It's also, so it's not just the red tape. It's complicated. There's a lot of peeking into your life. People feel like they really have to put too much and expose too much. It's just not a very comfortable experience. It's not a pleasant experience by any means. Inequalities. Program is controlled by states. For instance, here's an example. Look at this example. Georgia spends the least on welfare. Per capita, 1,126. If you contrast that to New York, 3,305. It's almost like New York spends 3 times as much per capita on welfare than Georgia. So the same family with the same needs is not going to necessarily get as much assistance. So it's unfair in that sense. So we don't have equity, right? Inequity is the opposite of fairness or equality. So those are major criticisms of welfare. What a program is supposed to do? A program is supposed to get people a job, be an incentive for work. It's supposed to get people, raise people's incomes. It's supposed to keep the program costs lower. So we want to get people out of poverty. We want to make sure that they have a job. And we also want to keep the program costs lower. And welfare doesn't necessarily do that anywhere near as well as, for instance, the other programs. So what are the 3 major objectives of any short-run poverty relief program, especially the negative income tax? To minimize income inequality, let's get as many people out of poverty as possible. Let's maximize the incentive to work and thus reduce the program costs. Those are the 3 things I was telling you about. So what do we prefer? We prefer negative income taxes. So here's an example of negative income tax. Negative income tax is the guaranteed income, remember? So let's say, for instance, here that the income cutoff was set at 40,000. The negative income tax percentage is 50%, and somebody makes only 20,000, which means they are short 20,000. They get 50% of that 20,000 in a check, $10,000. You're supposed to be making 40,000. You only make 20,000. The government makes sure you get the difference, half of that difference. Now, if this rate was 25%, they would get 5,000. So that rate dictates how much they actually might end up receiving. A negative income tax here was championed by Milton Friedman, and Milton Friedman liked it more because it gives people cash as opposed to in-kind benefits. Remember, we want a program that's simple, doesn't need a lot of monitoring, doesn't need huge offices, and it doesn't have bulk. And this takes all that out of it. It also gives people more independence and more sense of privacy and control in their lives. And the psychology of that is really very powerful, very important. Behavioral economics focuses on that. And we have really been seeing, as the studies rule in, how important that is. While people would still lose benefits, right, as they make more, the negative income tax, they would always come out ahead with a higher income. So this is just, it's as far as, is it going to help more people? Sure, because you can help more families that work than if all of them don't work, which is like on welfare. So you can help more families that way, you can spread the money more versus welfare. Is it incentive to work? Because you have to have an income. So first you're working, that's why you're qualifying. And 3, it's done through the IRS. Come tax time, you're filing your taxes, you qualify for certain things. You don't have a whole special department. So it fulfills the 3 objectives much better than welfare. One last thing I want to leave you with, and that is the 6 factors that contribute to income inequality. You know what? I'm going to stop this video and start a new one because these are very important. I don't want to have to rush through them. So I will pause right here. I'll see you in video 4. And this is really important. Come back and look at this. It's helpful to you as an individual.